Everybody. Oh, here we go. Got it. Good morning, everyone. If you don't know me, my name is Kelly McGinnis. I'm the branch manager for Prime Lending. I am responsible for managing mortgage offices in Connecticut and Vermont for Prime Lending. I've been in mortgage lending, I'm afraid to tell you, under all this long blonde hair is a lot of gray hair, but this is my 39th year in mortgage lending. So I've been doing a long time, seen a lot of things, and I'm always so excited to do this course for people because as real estate agents and mortgage lenders, our business is so closely entwined and interconnected. And I think to the extent that we can both have somewhat a working knowledge of each other's professions is certainly helpful. The point of today's class is to not—
No, the host is in there.
Oh, it is. Okay.
I'm the co-host.
Rach, I think you need to go on mute, honey.
And Kelly, just in case.
I'm sorry, Kelly's.
Rach, you need to be on mute, hon. Okay, perfect. So the point of today's session is not to make you mortgage experts. It's to just hopefully give you a working knowledge of
Jen said that she
things
heard
that are going to impact you.
it was increased for the whole company, and that's where it's at right now. So it should be things that whatever Crystal did is for everybody from now on.
Yeah, can I just ask everybody go on mute, please? And Rach, I'm not sure if that's the association or not there.
No,
Okay.
it's like that.
Okay, perfect. Thank you, everyone. And certainly if you've got questions, you can unmute yourself and ask questions, and we are going to use the chat feature. After the session today, after we close out and whatnot, I'm going to do a little raffle for a $100 gift card. And anytime you respond to any of my questions in the chat room on this, we're going to enter your name into draw. So the more engagement and the more opportunities that you have to connect with me, the greater your chance of winning that fun $100 gift card. So thank you so much for that. So again, normally I really spend a lot of time in certain segments of this, but I've added a section to the end of this workshop, which talks about where interest rates currently are and where interest rates are going, because of course that's all the buzz. And I normally do another workshop on financial trends and data analysis and whatnot, but we're going to add a little bit of that to this. So parts of this presentation, I'm going to go through a little bit quicker than normal, but if you have questions or you need anything, please don't hesitate to reach out. And then Kat, I've got a couple people from my team on it. I didn't see Wanda, but Kat, could you do me a favor, please? And just take screenshots of the chat section so that as we know people are entering in for the raffle, I can actually do the raffle entries for me, okay? And then finally, I would also ask you, oh, there's Wanda. Wanda's here too. If you could also just pay attention to the chat feature and let me know, because as I go through, if somebody's got, I may not see it. So just don't hesitate to interrupt me if somebody's got a question that's pertinent. I love doing this class in person. I do want to thank everybody on this call. I had a death in the family last month and wasn't able to come for last month's class, and I appreciate everybody's patience and understanding that I needed to reschedule this for today. So thank you very, very much. All right, so let's get started. So mortgage lending, let's see if I can move my screen. Okay. I'd like to give everybody a preview of kind of what the world of mortgage lending is about, because oftentimes you're going to hear, or I will hear from clients and from realtors alike, well, I don't understand what the problem is with the lender. We know we're going to be able to pay our loan back, or we know, this doesn't make sense to me. And it is complicated and it can be hard to understand sometimes. So these next couple of slides, I'm just going to give you a little bit of an overview about what controls mortgage lending and why sometimes what might seem like a common sense decision doesn't really end up that way. So in the top left corner, basically what you know is that as a lender, we give a secured loan by real estate to a client via a mortgage. I always like to tell people think the mortgage is the actual IOU. The actual IOU on in a real estate transaction is the loan note. That's the IOU. Then we have real estate, and it's the mortgage document that actually secures the note to the real estate. Just kind of a fun fact. So when people oftentimes will get confused between what the mortgage and the note is. Mortgages have become the vernacular for the loan. I mean, that's what we call them, right? Mortgages, okay? This creates a debt for the borrower, but an asset for me as the lender. So the client has, I now own an IOU, and it's a debt for the client. As a lender, we then sell that asset to any one of a number of agencies: Fannie Mae, Freddie Mac, HUD, VA. Those are all government regulated industries, okay, in different ways, shapes, and forms, but they all have a government relationship. And then in the case of jumbo loans, and we're going to talk a little bit about what a jumbo loan is later, those are all private investors. Those are not regulated or do not have a relationship to the US government. And as such, they are managed and underwritten completely differently. Now, you know that customers will often say, I don't understand it. My loan got sold. My loan got sold. It's important to know that we do sell the servicing of mortgage loans throughout the country. It's not uncommon that a customer closes with a lender and within 3 months, 6 months, sometimes the first month, they get a notice that the servicing's been sold. Whenever servicing is sold, the loan terms do not change. So whatever the loan amount was, the terms of that loan, if it was a 30-year fixed, whatever the interest rate is, that never changes. It's simply changing who the client makes their payments to, okay? What the government then does when they buy that asset is they package the loans into securities that are sold on Wall Street. Now, if anybody knows anything about the subprime mortgage crisis that took place in 2008 to 2018, depending on where you were, you know, that's what created the issues there, right? It's how they were packaging those and how they were selling them. We still do that today. They're called mortgage-backed securities, and this is what drives a huge amount of what happens in the mortgage industry, is what Wall Street's appetite is willing to buy or not buy in those securities. Wall Street then packages those mortgage-backed securities and puts them into pension funds, hedge funds, money market accounts, retirement accounts, etc. And of course, who owns those accounts? Homeowners. So I always say that mortgage loans is like, it's like a circle of life, because it starts with the homeowner and it ends with American citizens who own these mortgage-backed securities in their investments. Now, the mortgage meltdown is something that I'm going to spend a couple minutes talking about, only insofar as the impact it had on how we lend today. So as a quick overview, what subprime mortgages were, what happened with the meltdown is that poor quality loans were packaged and marketed as high quality loans. Meaning, when that Wall Street piece took place, there was no differentiation between poor quality loans and high quality loans. What made loans poor quality loans back then was 100% financing, no down payment, poor credit, no income verification, all of these high risk lending standards that were taking place back in those years, okay? So what happened is, when the housing, and what all of those subprime lenders were banking on, and by banking, I'm using a very appropriate word here, was that real estate values were going to continue to increase. Because what was different about subprime loans is they were adjustable rate loans that would come due in 3, 5, or 7 years. So the idea was that customers would just continue to refinance those as their property values were going up. Well, what happened? We hit a recession, started out west, property values started coming down during that particular, I'm sorry, they didn't come down, they actually stalled. The housing values stalled, and now clients didn't have the room in their home to refinance. Delinquencies and foreclosures became epidemic, and the entire mortgage-backed security market had to be revamped. And this is when I say the government intervened, okay? Like it or not, and we're not here to debate whether it was a good thing or a bad thing. It was very good in some ways and problematic in others. The government got involved with the most historic financial reform laws ever seen in America, and that was the Dodd-Frank law, offered up by Connecticut's Chris Dodd and Massachusetts Barney Frank. And basically what it left us with was today's lending environment, which is highly regulated. It has huge penalties and fines and additional covenants to lenders that we have to operate in a responsible manner. And what it means is it equals slightly more restrictive lending, although it's still really, really lending is not as, right after this happened, they're like, oh, it's so hard to get a loan. And I would tell you right now, it's not so hard to get a loan. We are far more flexible today, even after the subprime housing crisis, than we were when I got into the mortgage industry in the early 80s. So, you know, there's still a lot of flexibility and opportunity for people to get loans. But what I want you to understand is that second sentence, which is huge penalties, fines, and additional covenants for lenders. And that comes out in this slide in what's called the ability to repay rule. So essentially, and I'm going to water this down, but essentially what the federal government came in and said is there's a certain way a lender has to qualify a customer in order to be protected against fines, penalties, and repurchases. Okay. And the way that we now look at loans is we are doing a thorough job evaluating income, credit, debt, assets, and the property, as well as documenting it appropriately. So what will happen is, let's say we've got a client who feels like maybe some of the paperwork that we're asking for is onerous or outrageous or too much. I always make sure that they understand, yes, I know you can repay the loan. Yes, it's clear that you can repay this loan, but we have to be able to prove that you can repay this loan in documentation to Fannie Mae or Freddie Mac or HUD, okay? And if we haven't documented it appropriately, those government agencies will force the lender to buy back the loan. And I'm here to tell you that is very, very expensive. So when you hear about lenders asking for documentation, that might seem a little bit extreme for you. That's usually at the heart of it. And oftentimes what will happen is we'll start seeing that Fannie Mae or Freddie Mac or HUD for FHA loans or the VA has started scrutinizing a particular area of lending a particular way, and all of a sudden we'll see them coming back and asking for more documentation. And that's when we know that they've probably experienced some delinquencies in that area that they hadn't before, and now they're cracking down on documentation. So it's a fluid situation. Somebody who applied last year and now wants to apply again this year may have to prevent different documentation than they did before, okay? Now, the actual Dodd-Frank law, the ability to repay rule, okay, basically says this: if a lender does not demonstrate through the standards of the law that they made a responsible lending decision, the client has recourse against the lender to say, you should have never given me the money, and to no longer be responsible for the debt. So think about that. If we don't follow the ability to repay rule in the Dodd-Frank law, a client could come back and say, should have never given me the money. Because of course, didn't we hear a lot of that during the subprime crisis? We should have never been given the money. We should have never been given the money. And there was a lot of predatory lending that took place back then, and they should have been given the money, and it put clients and homeowners at risk. But the government's going to make sure that that never happens again. Never happens again. So I have a quick question for you that you can start in the share section. If you're interested in the subprime mortgage crisis, has anybody seen the movie, oh my gosh, The Big Short? Because if you're really interested in understanding what happened in the subprime mortgage crisis, I would recommend you watch the movie The Big Short. It's very good. They do a very good job explaining it. Go ahead in the chat section and let me know if you saw it or didn't see it, because it gives you an opportunity to enter into the raffle. But I thought it was the best way to describe to the American population exactly what happened in the subprime lending crisis. So coming out of that, we were left with what we call layered risk, okay? And what layered risk means is we need to put all the pieces of the jigsaw puzzle together for a client. So it's not uncommon that somebody might say to me, listen, I have an 800 credit score. So what? I've been self-employed for only 4 months. I've always paid my bills. You need to give me the loan. And back in the subprime days, they would have received the loan. But today, every single piece has to meet the criteria that's set forth. So we're going to be looking at credit scores, income and debt, also known as debt to income ratios, their employment, their assets, and we're going to be taking a hard look at the property. All right, let's dive into this. So what's important to understand about credit scores in credit and what somebody's credit profile looks like. And it's really important, guys, that you understand those are two different things, right? The credit score basically is a compilation, but then within the body of the credit report, we have to evaluate what we see as a client's or a buyer's willingness to repay this debt. And the way that I always say that is, you know, I've had clients who make very little money and have, you know, taken 3, 4, 5 jobs to make sure they never go late on a single payment that they are due. And that demonstrates willingness to repay. Similarly, I've had wealthy clients who felt they didn't owe money on a particular debt, didn't pay it. All of a sudden they're upset that, you know, there's delinquent credit on their credit profile. Willingness to repay. Credit scores impact interest rates and PMI rates. And by PMI, what I'm talking about is private mortgage insurance, which is required anytime you're putting less than 20% down. Credit scores also impact underwriting, okay? And that's that layered risk piece that we talked about. You can have somebody with a low credit score not able to get approved on certain loan parameters, and yet someone with a high credit score and everything else being equal can. So credit scores are very, very important. I think it's important to understand that what we deem as core scores are any score 620 and under, okay? We do lend between 580 and 620 in mortgage lending, but with restrictions, okay? So if somebody has really struggled or had a life event that's impacted their credit scores, then oftentimes we can lend, but we're going to be more conservative on all those other layered risks that we talked about. Good scores, and this is even debatable, I would say is between 640 and 720, and excellent scores are 720 and above, okay? It is interesting to note that what lenders, because of all the data that we have on the performance of loans, we know which clients are going to be in a better position to repay than others. And according to HUD, who purchases FHA loans, clients with credit scores under 640 are 4 times more likely to become delinquent or default. Now, I want to say this. There's 2 things about this, right? A lender never goes in to a mortgage loan thinking, oh, well, if they don't repay, I get the house. Because foreclosing on a house, especially, my friends, in Connecticut, is very difficult and very expensive. All right. So the idea that just because they've got security in the property means they should be making loans regardless is not true. And secondarily, I think it's important to know we don't want to put clients in a position where they're going to face financial catastrophe, because that follows with them, that stays with them for many years. So responsible lending is really helping buyers and families figure out what their affordability is and putting them in a position to succeed. And that, I have to tell you, is truly, in my humble opinion, the most important thing. Now, let me ask you a question. If a client tells you that their Credit Karma score is a 640, do you think that's going to translate to their mortgage credit report score? And if not, do you think our scores are going to be higher or lower than Credit Karma? Go ahead and put that in the chat feature. Right. So the reason that I bring this up, this is something that you as an agent working with a buyer may have an opportunity to discuss with a client, even though you're not their lender, okay? And here's what it is. So with credit scoring models, there's different models of credit scoring. Some of them are more intensive and do a lot more analysis than others. You can imagine that the free credit reporting models that are out there, Credit Karma, Capital One, anything you get on your credit cards, those are the least expensive model because they're for free to the client. So who's ever sending them out is not spending a lot of money on that credit scoring system. And so as a result, Credit Karma scores can often be 40 to 100 points higher than a mortgage credit report score. So if you have somebody and you're starting to talk with them and they tell you that their Credit Karma score is a 620, you're going to want to get them in the hands of a mortgage lender as soon as possible, because 620 on a Credit Karma score means they're probably not in an acceptable lending range for a mortgage lender. And to the extent that we can determine that early and help them through that process is so important. Now, at Prime Lending, we have something called credit risk scoring, which means we can run a very quick report to see if there's any quick fixes a client can do to repair their credit scores. And if that's the case, we'll report it back to the client, have them follow the process for doing it. And we have great success on getting really sometimes very significant increases in credit scores for a quick fix. But oftentimes, if they have to go into credit repair, like a true credit repair program, that can take months. So as a realtor, you don't want to be spending your time with somebody who's really not going to be able to qualify. And I would give you this other piece of advice. If you have somebody who has a substandard credit score and they say they're going to do credit repair on their own, it is very rare that that's successful, very rare. So I use credit repair as a hurdle, if you will, that if I have a client who's really serious about buying a house and they're willing to go into a reputable credit repair company, then I'll continue to work with them. But if they're not willing to sign up with a reputable credit repair company, I'll certainly be here, later in the process, but it's not going to be a huge investment of time because the person's probably not going to experience success and, may not be taking it seriously. Okay. So derogatory credit is when we see past dues, collection accounts, profit and loss, judgments. Those are what's considered derogatory credit. What's important to know is that if you've had someone who's had a short sale or a foreclosure or a bankruptcy, there are mandatory waiting periods before they can get a new mortgage. So in conversation, again, if you're speaking with somebody and they tell you they've had a short sale or they had a foreclosure, I once owned a house, but I lost it, or I came upon hard times, I had to file for bankruptcy. Again, you want to get them in the hands of a mortgage lender as soon as possible to see how they do. I'm going to give you another working piece of knowledge that you can understand so that when you're talking to your clients, you might be able to give them a little bit of guidance. In Connecticut, we are known as a judicial foreclosure state. Remember, I just said it can be really hard to foreclose in Connecticut? Well, we are a judicial foreclosure state, which means that the state of Connecticut usually sides with the homeowner and makes it very difficult for lenders to foreclose. Has anybody ever heard of somebody who lost their house in foreclosure, but then kept living in the house for another 2, 3, 4 years? If you've heard of that, that's my point, okay? If you've had somebody who filed bankruptcy and also lost their house in foreclosure, those are two different events. And it is not uncommon that a homeowner thinks that their foreclosure date was the same as their bankruptcy date. And that is not true. And it catches I've had really difficult conversations with some customers who thought that their foreclosure was 4 or 5 years ago, only to find out, this is a true story, they haven't even been foreclosed on yet. And they thought the whole thing was done and over because they filed bankruptcy. So, and the waiting period on foreclosures is longer than the waiting period on bankruptcies. So if you're talking with someone and they happen to mention this, you want to have them call a reputable mortgage lender, most notably me, so that we can get to the bottom of this later, right? It's really problematic. It's a very difficult conversation to have with a client. I've talked to you a little bit about the credit repair, so we're going to move past that. Does anybody have any questions yet before I keep going on credit?
Can you hear
I have a
me?
comment. Go ahead. Somebody have a question?
Yes. Who are reputable credit repair?
I have that. Yeah, I have that too.
Okay, so I think, I'm so sorry, I'm having a hard time hearing you. I think you're asking who are reputable credit repair companies?
Right.
Okay, so I have 3 that I recommend. They're not related to me whatsoever.
I have spoken.
All 3 of them I've seen do a good job. When I say reputable, there's a lot of what I would call multi-level marketing credit repair companies out there that I've heard a lot of I've heard a lot of negative feedback about. The credit companies that I recommend are all, one of them is owned by attorneys, another one, they're all like national. I can send those to you after we close. I mean, after we close. See, I've got loan closings on my mind. Send it to you when we're done, and let you know who I work with, who I've seen do a really good job for customers. Okay. You're welcome. Getting to income, I want to let you know right now that income is demonstrates the client's ability to repay, right? So if credit is a willingness, income is the ability to repay. Now, this is an important conversation that I have with all my clients, especially my first-time buyers, to make sure that they really understand what they qualify for. And it's not uncommon that you tell somebody they qualify for a lot more than they're comfortable paying. So while I'm going to give you these debt to income ratios now, which are benchmarks, I have to tell you, I spend a lot of time during the financial consultation with the potential homeowner and talking about really where their comfort level is. And that goes 2 ways. So let me explain it to you. So back before 2000, your debt to income ratios were what's called 2836. And these had to be done by hand, guys, back in the dark ages. And they, what it said was 28% of your gross monthly income, no more than 28% of your gross monthly income could be allocated to your new mortgage payment. So if you ever heard the expression that your rent or your mortgage should equal 1 weekly paycheck, this is where it came from, okay? And it is important to understand that we use gross income, not net. So when we're qualifying people, we're looking at their gross income. And then the back end ratio we called is 36%. That was all their other debt, their car loans, their student loans, their credit card payments, anything like that, plus the housing payment, the new mortgage payment, could not exceed 36%. This was the strictest lending we've ever followed in America when it comes to debt to income ratios. Then what happens? 2000 to 2008, shudder to think about it, anything goes. We were seeing people who basically could demonstrate any income getting loans. So they had ratios of 100 to 100. Today, we're not really talking about that housing payment anymore. We're really geared to what we call the back end debt to income ratio. And kind of here's what we look at. If somebody's debt to income ratio is under 38%, that's a conservative, affordable payment. And I counsel people and let them know that 38 to 43% is considered acceptable. Once we get to 44 and above, and guys, we on some loan programs, we're seeing approvals at 58 and 59%. But even though we can get that approval, that's stretching it. And so I always have a bigger conversation with the clients. Now, I've had people in these classes debate me and say, well, you should never be giving the money. That's too much. You shouldn't be going that high with somebody. And here's what I always say. You have to remember this is a documentation business. So if I have someone if I have a young couple and the wife is self-employed, but doesn't show all of her income on her tax returns, or one of the borrowers has poor credit and we're going to take them off the loan because they can get a better rate with the other partner's higher credit score. Well, in those situations, we need to be able to stretch somebody's ratios, right? Because we know there's extra income there. We just can't use it in the transaction. There's a very important place for those higher ratios if done responsibly and with great conversation and consultation to the clients. Okay. Oh, I'm so sorry. I am like going through, I clicked my wrong piece of my mouse. Okay. And always, 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 when it comes to verifying income, we always need to see a history and we need to see a continuance. So here's some crazy examples. Self-employed borrowers have to be self-employed at least 2 years. I need 2 years tax returns in order to be able to do a loan for a self-employed borrower or to have used the self-employed borrower's income. Someone who's receiving child support as income. I have to be able to see that that child support is going to continue for 3 years. How do we do that? In the divorce decree, we see the age of the children. And in the state of Connecticut, the way child support laws are written, they time out at 18. So if I'm going to use child support to help someone qualify, I've got to know that support, that the kids are basically under 15 years old in order to use that. It's always about history and continuance. And for those 2 examples I gave you, there's so many more. But what types of income can we use? We can use employment, second job income, commissions, bonus, business, rental income, alimony. I mean, these are all acceptable sources of income that we use when helping someone qualify for a mortgage loan. Again, always want to make sure we're testing for stability, history, continuance. If someone works multiple jobs, they have to have a 2-year history of doing that. If someone works part-time jobs, we need to see a 2-year history of doing that. And again, if they're self-employed, we need a 2-year history. So it's not uncommon that somebody says, well, you know what, I want to buy my first house, I'm going to go get a second job now. Unfortunately, that doesn't help them qualify for a bigger mortgage because they don't have the 2-year history. What types of debts are we keeping when we look at that debt to income ratio? Any mortgages they have, auto loan payments, auto leases. We use their current credit card minimum payment as reported on the credit report for any credit card balances, personal loans, student loans. So student loans right now, I mean, of course, what a day to be doing Mortgage 101 after all the announcements on student loan forgiveness right now. And again, we're not going to get into that. But student loan debt is it's horrifying as a mortgage lender for me to see the amount of student loan debt that people are carrying and the amount of student loan debt that's deferred, which means they're not making payments and those principal balances are continuing to grow. Okay. So when we're looking at student loan debts, I always dig in deep and ask who's paying the student loans. If it's the parents, and I can verify, let's say it's a young couple who's buying a house and they show a lot of student loan debt. If their parents are the one making the payments, which is not uncommon, we'll get documentation showing that the parents make the payments and then I don't have to count it against the couple. There's a big misnomer that if your student loan is in deferment, we don't use a payment. That's not true because at some point you're going to have to pay that payment. So we use, if somebody's in deferment, there's different guidelines on how we have to calculate what their monthly payment would be. And that varies by loan program. And then finally, if we've got, has anybody here ever heard of income-based repayment student loans? This is when if your profession qualifies, it's usually a profession that they've tried to attract. I know nurses typically qualify, physicians qualify. There's a variety of positions that can get into income-based repayment loans. And what that basically says is every year you're going to verify your income to the government and they're going to have, based on your income, tell you what your student loan payment is. And it's always a lot lower than what the actual payment is. If we can verify the income-based repayment, there are some loan programs that let us use that amount. Okay. I've actually recommended to some of our clients that they go into income-based repayment just so that we can get them qualified for their loan. So again, working with a mortgage lender that understands all these guidelines and can really help put this whole thing together to help people maximize their qualification is so important. Any other questions on this stuff yet? Okay. So we're going to talk about assets. This is another piece that we're constantly looking at, right? What are the what assets does a customer bring into the transaction? Most important asset we're going to always want to look at is what we call borrower's own funds. So we're going to be looking at their bank accounts, their retirement accounts, stock accounts, money market accounts. We typically need 1 to 2 month season bank statements. So let's talk about, gosh, cash is king today. I'm so surprised at how many people, and I think this really happened a lot coming out of the pandemic. And I think it's also happened a lot with multicultural lending. There are certain segments of our population that don't trust banks. And so as a result, they keep all their money in cash, okay? And it's important to understand that we have a little bit of flexibility to have cash in a mortgage transaction, but only a very little. After the 9/11 attacks, the government passed the Patriot Act, which was an anti-terrorism act, which basically means any financial institution that sees cash going into a transaction has to basically scrutinize it very heavily, because terrorists, frankly, use real estate to launder money in this country. So if somebody's got cash on hand, typically we're recommending that they get that money in the bank, and that they wait 60 days until it's no longer a large deposit on their bank statement, so that we can then use it in the transaction. But it's really important to understand that's the problem with cash. Similarly, they can't go to borrowed funds are not allowed in a transaction. So recently I've had a run of people who said, well, I took a personal loan out last year for $25,000. That's my down payment. That's not acceptable funds. It's just simply not an acceptable source of funds in a mortgage transaction. And we're going to always track large deposits. So if we see somebody's bank statement and there's a large deposit there, they're going to have to document it. And if they can't document it, we'll then remove that amount of money from the balances and hope then that the client still has enough money to close. And this is why, guys, it's so important when you're getting a pre-approval from a lender that you've worked with a lender who looks at all of this up front. I'm constantly rescuing deals from other lenders who didn't get bank statements up front, and then client gets into contract, they pay for the appraisal, they pay for the home inspection, and all of a sudden some large deposit is creating havoc in the transaction. And that should have been addressed at the time of the pre-approval, long before they ever went out shopping for a house. So that's something that's really, really important, is that you guys work with lenders who are doing a really thorough job getting all the documentation up front and evaluating it. Gift funds are allowed. Big announcement came out in the last couple of days on FHA loans. Typically, gift funds can only be from family members, but FHA did announce close friends can now provide gift funds. Okay. Well, the big announcement was friends could always provide gift funds, but you used to have to document the relationship. So can you imagine? I was taking screenshots of people on Facebook together. How do you document somebody's a good friend? It's so difficult. But the big announcement, they no longer require. So that was great news. This was my favorite until 2020. Okay, seller paid closing costs. Has anybody ever used this strategy to help a buyer come up with money for down payment and closing costs? You can enter it into the chat section. I'm going to peek at that one. Yeah, Lynn, I am going to go through pre-approval versus pre-qual in a minute.
Okay.
So seller paid concessions is a really effective way to help a buyer come up with enough money, a first-time buyer come up with enough money to buy a close. The problem with it in this current market since 2020 is that you have to have the willingness of the seller to participate. So here's a quick example. You have somebody who wants to buy a house for $100,000. They don't have enough money for the closing costs. So they go to the seller and say, guess what? We would like to buy your house for $106,000, and you will give us $6,000 towards our closing costs. Fantastic. Before 2020, I would tell you that the majority of first-time buyers use this strategy. Now, it's really important to understand in that situation that the house has to appraise. What happened in the seller's market? They don't have to do it. And also what happened with the market over the last 2 years is everybody was worried about appraised values. So if all of a sudden you were going to front load closing costs into that transaction, they oftentimes wouldn't even consider it. So this strategy has been sidelined for the last couple of years. I do think it will start coming back in the next year or so, over the next year, I should say. But it's important that you understand how it works, because it's something that you guys will be talking about with us as lenders and putting into your contracts. Okay, but it's essentially a way to elevate the sales price, assuming the price will cover, assuming the house will appraise out, and then to get some closing cost money back into the client's pocket. It's important to understand, guys, a calculation that we use a lot. We call it cash to close, and this is the math here on this slide at the bottom. So basically, cash to close is a combination, and I go through this with every single client. Your cash to close is the total amount of money it's going to take you out of pocket to buy this house. And cash to close is made up of several key important ingredients. One is your down payment. Then to that, we add what I call your hard closing costs. This would be your lender fees, legal fees, city recording fees, all the hard closing costs that go along with buying a house in Connecticut today. This is actually a little bit late. Those have gone up in the last couple of years. It's probably about $5,000, between $5,000 and $6,000. Then in addition to that, in Connecticut, you're going to always have to pay 1 year of homeowners insurance up front, plus put 2 months of that into your escrow account. No matter what lender, this is what you're doing. And in Connecticut, with the exception of Wallingford, Meriden, and Trumbull, you're coming to the closing with between 8 to 9 months worth of property taxes on every single closing. So when we're talking to a client about a particular house they want to make an offer on, we make sure that they have that total cash to close number on every single property. You should see some of my text threads with some of my clients. They'll say, you know, what are my numbers, Kelly, on these 4 houses? And we always give them their total monthly payment and their total cash to close, because deals will fall apart if buyers are not accurately prepared for this financial information. Your deals will fall apart, because most clients don't understand the closing cost component of buying a house. And most lenders, guys, hand to God, most lenders don't review it with them. So it's very common that, again, I'm stepping into rescue deals because the client had no idea they were coming to closing with 8 to 9 months worth of property taxes. So you think about somebody who's buying a house in Hamden or buying a house in New Haven, and all of a sudden they're coughing up 8 to 9 months worth of taxes that they had no idea they had to come to closing with. It's catastrophic if they don't prepare for it. Catastrophic. Any questions on that? Okay. All right, so I'm going fast because I really want to get to this interest rate piece. So guys, you guys are always talking about purchase price and down payment, right? So when you're writing up contracts, you're focused on what's somebody's down payment. As lenders, we're focused on the opposite calculation. We call it loan to value, LTV. What we're focused on is what's the loan amount compared to the purchase price. So you guys are talking about somebody who's buying a house with 15% down, and we're talking about the fact that that client has an 85% loan to value. All right, you're talking about your client who's doing a loan with 5% down. We're talking about the fact that it's a 95% LTV. Now, doesn't it make sense that the less money down, the higher the risk of the loan? You'll hear it called skin in the game, right? So it wouldn't be uncommon that we're trying to pre-approve someone, and at 95% loan to value, or in your language, 5% down, we're having a hard time getting them approved. But if we show them putting 10% down, all of a sudden we have an approval. Loan to value, their down payment is one of the single greatest things that's going to determine whether they can qualify for a loan or not. It's the highest. Credit scores and loan to value are the highest risk components of the mortgage loan transaction. All right. And whenever you are going to put less than 20% down, you need PMI, private mortgage insurance, also called mortgage insurance. Now, for all my millennials on this call, millennials hate mortgage insurance. I want
You too. Wait, which day is best for the best?
Melissa.
Every day?
No.
Every day? Yeah.
So,
Okay.
Sunday,
Okay, here we go. Great. I didn't realize I could do that till just now. So those are the highest criteria. So anytime you're putting less than 20% down, you need mortgage insurance. And as I was saying, millennials today hate it. It's got a bad rap. People will tell me they're not even going to buy a house because maybe They're going to wait till they have the full 20% down. It's got this bad rap. And I'll run financial comparisons to show them how much more expensive it's going to be to wait versus paying mortgage insurance. We've had mortgage insurance on loans since the dawn of mortgage lending. Again, not sure what the internet has done to spread all the malicious information about this, but you're going to have mortgage insurance. Of course, what's been so important in this market over the last 2 years is the way we lend. Our loan to value calculations are based on the purchase price or appraised value, whichever is less. So in 2020, I've always trained people on that purchase price or appraised value, whichever is less. Most people never paid attention to that until 2020 and 2021, because what was happening? We were seeing appraisals starting to come in low, right? And that's because we didn't have enough data in the marketplace to support the rise in property values. It's important to remember that with appraisals, the appraiser has to look over the last 6 months on comparable sales that have closed. So when you're dealing with two issues like we have in Connecticut right now, one, increasing sales prices, so the 6-month data isn't keeping up. And number two, lack of inventory, lack of data, we've seen low appraisals. Now, in the case where we have a low appraisal, I'll often say to my client, just because this is coming in low right now doesn't mean the house isn't worth it. Because I've had a couple of deals this year, guys, true story, where my appraisers called me and said, hey, you want this appraisal back by next week, but we know that there's a sale closing. And if I get it to you next week, the house isn't going to appraise. But I know that there's a sale closing at the end of this month that would allow the house to appraise. That tells you that this is a lack of data issue, not a value issue. So this happened to me twice in 2022. And in both cases, we went back, renegotiated the contracts with longer closing dates so that we could wait for those comparable sales to close so that we could get the value that was apparent in the marketplace based on those most recent sales. It's crazy, right? Crazy. The other thing that we started doing at Prime Lending, I stepped in very early on this, is we worked with all of our appraisers to be able to demonstrate analytically that property values were going up. And so one of the ways we combated this is we used what was called marketing time adjustments, where if we were getting an appraisal in, but the comps were 6 months old, they would give us 0.5% a month on those values to increase it because we knew property values were going up. So there's a lot that we can do on it. And of course, when it comes to property, guys, and I know you know this, it's all about condition, right? What's the quality of the condition? And we're gonna always be worried about, certainly on FHA loans, if we've got peeling paint, lack of hand railings, any safety concerns. But if an appraiser sees something on a conventional loan that's a code violation, they have a responsibility to report that as well. So it's not uncommon that you would see somebody, you might see like a hand railing has to be put in on a conventional loan too, if it's a code violation within that town. So you want to be paying attention to that when you're listing properties, just taking a quick peek at where you think there might be safety. Hand railings are the big one, right? The lender, appraisers and lenders, the worry is somebody's going to fall down the stairs and wind up suing the lender because there should have been a hand railing. So hand railings on any stairs are a really big thing. Lynn, to your point about pre-approval versus pre-qualification, I want to go through this with you. So here's what I want to read. Your pre-approval or your pre-qualification, regardless as to what it's called, is typically only as good as the loan officer who is doing it. Okay? And it's really important for you to understand that it's only as good as the loan officer who is doing it. Now, we happen to call the process that we have a pre-qualification unless we put the loan into underwriting. And we do put most of our future buyers into underwriting today. But a true pre-approval means you've gone through, if we're going to talk about what it really means, it means you've gone through underwriting. An underwriter has looked at the loan, approved the loan with whatever conditions they may want, and essentially everything's all set. You've got a lot of lenders out there who will have the loan officer pull credit, run some numbers by hand, issue a pre-approval letter. It will say pre-approval on it. And again, it's only as good as a piece of paper. I had to step in on a deal a couple months ago. Citibank, the loan officer never pulled credit on the client. He was in contract, went to go apply. You know, like who would think that a loan officer at Citibank would even have the ability to not pull credit, but issue a pre-approval letter? Okay, so it's a two-step thing, right? It's what does any particular lender call it? And because ours says pre-qualification, we were up against some competition from some of the in-house mortgage companies who said, oh, prime lending is doing a pre-qualification. They're not doing as thorough a job. And I'm like, yes, we are. We just don't believe it should be called a pre-approval unless it goes through underwriting. But what we do, our process now is that we collect all the documentation. We get pay stubs, bank statements, W-2s, if necessary, tax returns. I personally, or someone on my team who's incredibly well qualified, evaluates all of the documentation. We're looking for all the things that I told you before could be problems on the documentation. And then we run it through automated underwriting. And at that point, we would issue our pre-qualification letter. And, you know, Linda can tell you because she's worked with me. And, you know, a pre-qualification letter from Prime Lending is often 10 times better than a pre-approval letter, perhaps from another lender who has only pulled a credit report. Or what's coming in now is they're only pulling a soft credit report. So, you know, it's really important to understand what lenders are doing in this process. We've taken in 2022, we took the next step that most of our buyers were putting into underwriting and getting them actually pre-approved by a human, which is a great phone call to make, because when my customers are out making an offer on a property on the weekends, I get to call the listing agent and say, they're essentially clear to close pending a contract and an appraisal. And it's really helped a lot of my clients win the deals. So getting them through our underwriting department has been a real competitive advantage for people this year. General rule of thumb, this is staggering. This is a good tip for you guys to know when you've got people, you know, out in the car looking at houses, or you're trying to help them decide what they're going to offer on a house. General rule of thumb, $10,000 in financing is equal to $50 a month in their payment. If you have somebody who's like, oh, I don't know, I don't think I want to go up $5,000. $5,000 on the purchase price is a lot of money. If you let them know that that's about $25 a month in their monthly payment, it can change the conversation very quickly, correct? So that's another tip there for you guys just to know. Similarly, I'll have customers say, oh my gosh, this payment is so high. What do I have to do to drop it by $250 a month? And This say, that's going to drop your purchase price by $50,000. So it's important to understand this rule of thumb for financing when it comes to what people think they can offer on a house or not. Is that helpful? Is that a helpful tip for you? Yeah. I'm wondering if my friend in the back is stretching, or is your hand up because you have a question?
Glad you could see me. I did have a question, but I forgot. So it goes back, I'll ask.
I'm having a hard time hearing you. Did you have a question?
You forgot
it.
Oh, you forgot it. Okay. Well, when you remember it, you can put your hand up again. All right, cool. All right, so guys, here's some of the loan programs that we most commonly use. Conventional loans, Fannie Mae, Freddie Mac. These loans, this loan program requires
She's doing a great job.
otherwise 5% down is the minimum down payment. They'll allow the seller to pay 3% towards your closing costs. They tend to have tighter qualifying ratios. But this was huge news last year. We are now doing conventional loan limits up to $647,750. Guys, you know, all right, here's a question for you. I want you to guess what the conventional loan limit was when I got into mortgage lending in 1984.
$200,000.
Yeah. Any other guesses? I knew George was going to be close. $70,000.
Oh, my God.
$70,000 was our maximum conventional loan amount when I got into the business. I told you there's a lot of gray hair under this blonde hair. All right, FHA loans, you know, such an important loan program in America today. It's for people who have fair to great credit. We will go down to 580, 3.5% down. Seller can pay up to 6% in closing costs. We have more flexible debt to income ratios on these loan programs. We are stricter on property conditions. This is where you're going to see conditions for peeling paint to be taken care of.
I know, like.
What did you say? You remember?
Yes, before I forget.
Go ahead. What's your question?
Have the actual, blueprint, for the appraiser, when he comes into the house, do you have that, the form that he uses for condition?
So there's, I don't know that I mean, certainly in every appraisal, we see the condition grading, right? I think what I can send you is what they describe for each condition. So the condition comes out as C1, C2, C3, C4. Most lenders require a C4 condition. So what I can send you is a breakout of what that definition is. Would that be
Perfect.
okay? Perfect. I'll get that over to you. Kat or Wanda, if you can just make a note. Is your name George?
Close, Paul.
Sorry about that.
Paul,
Okay.
you.
Okay. So do me a favor, in the chat section, just give me your name and we'll make sure we're going to get it out. We'll get it out to everybody because, you know, more information is better for everybody. We're going to also send you out a copy of this PowerPoint presentation as well. But that's important to know. So they are a little bit stricter there. And these loan amounts are different by county. And again, there's some fun things I used to tell you guys, but really what I want to get to for you is where interest rates are going. So VA loans are an important loan program in America today for our veterans. It allows the veteran to get 100% financing. It is important to understand that on a VA loan, all borrowers must be a veteran or be married to a veteran. Guys, true story. I've had 2 clients in my 38 years go to town hall, twice it's happened, go to town hall to get married without their parents knowing it because they had wedding dates planned, and get married so they could buy the house before they got married. Veterans have to be married to the veteran. I'm very flexible on ratios. And then our other program, CHAFA, the Connecticut Housing Finance Authority, is a very good program for low to moderate income families. You must be a first-time home buyer. There's all sorts of caps that we have to follow based on the town and their income. They're very strict on ratios. They will allow us to use down payment, and we can get down payment assistance and closing cost assistance on this program. So it's a very important program. The most important thing that I always talk about my clients who are thinking about a CHAFA loan is you cannot retain that property if you don't live there. So if you've got a young couple who wants to buy like their cute little first house, and then they're thinking someday they'll keep that house, turn it into a rental property and move on, it's not allowed on CHAFA. You have to sell the property, okay? And the penalties for that are pretty onerous, and I've heard some real nightmares. So we always have a real honest conversation up front so that people know what they're getting into with that particular loan. USDA, we don't see a lot of this here in Connecticut. My Vermont offices, we do a lot of it up here in Vermont. It's 100% financing in certain rural areas. The funds have to be approved by Congress each year. You know, again, not much to talk about in Connecticut. Jumbo loans. So the conventional loan limit goes up to 647.2. If you've got somebody buying a house and they need a loan for more than that, they're going to have to go into jumbo financing. And what's important to understand is jumbo investors do not have some of the safe harbor protections that all the other lending programs have because they're associated with the government. So we are very strict on jumbo loans, very strict. Okay, everybody is. The jumbo lending market is very strict. As a matter of fact, in 2014, there was a 6-month period of time where someone couldn't get a jumbo loan because the whole market had dried up while the industry tried to figure this out. Completely separate, different set of different guidelines here. Okay, and these are my clients who are usually the most grumpy about the documentation. You know, like you got to do it. So I didn't make the rules. You got to do it. And then finally, my last, last loan program, which I'm just going to touch upon. If you see that I'm doing a workshop in the future at the board for renovation loans, you want to sign up for it because this is a really important loan program. But again, got sidelined a little bit in 2020, 2021, 22. This allows us to provide financing to remodel properties. All right. I did a lot of fun seminars that talked about millennials and Joanna Gaines and the HGTV revolution and how when my daughter bought her first house, she wanted a house she didn't have to do anything to. And the minute she closed, started watching Joanna Gaines, she started ripping everything apart. It's very, very interesting. It's also a solution to the inventory crisis, guys. So if you've got somebody who's been out there looking and they can't find the perfect house because there simply isn't enough inventory, renovation loans are a really important solution because I've done a number of renovation loans over the last 3 years where people went ahead and closed on the house and then we refinanced them 8 months, 9 months later into full-blown renovation loans. I've turned capes into colonials. I did a big one in Guilford. I did a big one in Wallingford. They bought a cape. We converted it to a colonial, which is what they wanted. We've added bedrooms, garages, home offices. It's, it solves the inventory crisis. The difficulty is prior to the last 2 years, we would do the renovation loan at the time that they purchased the home. But because contractors are so difficult to find right now, we're closing the loans up front as a straight purchase. And then they get the time to go ahead, find the contractor, decide what work they want to do, and we refinance them. I did this with my son. I did this with my own son. Found a house. It wasn't perfect. We weren't going to have it. He was moving up to Simsbury. We didn't know any contractors up there. I said, let's close it. Let's close the loan as is. He said, it'll take me 6 months to get my contractors. I said, yeah, all right. 19 months later, he came back with his contractor. We refinanced him into a renovation loan and they got the house of their dreams. So a lot of ways to solve the inventory crisis if you've got buyers who are interested in hearing about it, okay? But keep that in mind.
Kelly,
All right.
no. What are the rates on average on a renovation loan? Are they higher?
Yeah, that's a great question. So the rates on a renovation loan run about 0.5% to 0.75% higher than non-renovation loans. So there is a rate markup for that. However, honestly, what we tend to do then is that I did this with my son is we then refinance them when the renovations are done back into a traditional loan that's a non-renovation loan for interest rate savings.
There's no time frame to stay in the renovation loan?
No.
Oh, perfect.
Yeah. And renovation loans, I want to say this last thing on renovation loans, they're not, everybody has heard of the 203K and most people have heard bad things about the FHA 203K. At Prime Lending, we offer something, I think we're up to 19 different renovation loan programs, conventional loan programs, jumbo renovation loan programs. There's all sorts of easy fixes that I can do. So we talk about let's talk about current market conditions for a minute. Like this is real world today, what's going on in the market. So we've got a lot of listing agents who have been, and sellers who've been reluctant to accept FHA pre-approvals or VA pre-approvals. Has anybody experienced this? If you have, just raise your hand or put it in the chat. Really difficult. I mean, they basically, these buyers almost got cut out of the market over the last 2 years. And it was very, very upsetting to me. So on a couple of occasions, I called the listing agent and two cases come to mind. In both cases, the listing agent said, well, I'm just not sure it's going to pass an FHA appraisal, or I'm not sure it's going to pass a VA appraiser. And I said, but I have solutions to that. And they said, well, what are your solutions? And I said, if we're talking about peeling paint and adding a hand railing, I can go ahead and close that loan and the client can do an escrow holdback program, self-help, where they don't even have to get a contractor to do it. We put a little bit of money aside and we can solve for that. And both listing agents actually didn't believe me at first. I'm like, no, this is how we can solve it. Both cases came back with minor repairs. If you go to my Facebook page and you go back a bit, you'll see there's a picture of me standing in Lowe's in the paint department for one of my veterans who was having a hard time getting a paint quote. And I said, forget it. You don't have to do this anymore. I know what we need. I'm going to go get it. And I drove down to Lowe's, stood in the paint department, got the quote that we needed so that she could close on her house and paint the peeling paint on the back deck afterward. Okay, we have solutions. So I'm only saying that, I'm really making that point because if you come up against a listing agent or a seller, or you've got an FHA or a VA buyer, don't be afraid to work with them right now, especially now that the market's kind of transitioning a little bit. Those, especially if we have them approved through underwriting, I mean, those are good loans and they're solutions to any concerns that the seller and listing agent may have. You just have to be well-versed. And can you imagine, once I start having this conversation with them, they have zero fear that I don't know what I'm talking about. And in both cases, they both got the deals. So I'm so happy to step in and help educate listing agents and sellers on those types of transactions. Same thing happens with renovation loans, okay? Same exact thing happens with renovation loans. Once you establish that you can articulate what these deals are all about, you have a much higher chance of getting them, getting their contracts accepted. And if you ever need any help or you want to understand that better, don't hesitate to call me. I'm happy to talk with you one-on-one about it. All right. So we're over our time frame, but let me give you, this is the information. If you learn nothing else from me today, I want you to be walking around with so that we can help stop the hysteria about rising interest rates. Okay. And here's your script. If people say it to you, if you have a buyer say to you, well, rates have gone up, I'm just going to wait. They're saying two things right now that are troubling. I'm just going to wait for rates to come back down. And the second thing, which is even more concerning to me, is I'm going to wait for property values to come back down when the next crash hits. Okay, so let's first talk about interest rates. Number one, mortgage rates follow inflation. And here's a chart that I've showed you that shows every time inflation goes up, mortgage rates follow. Inflation comes down, mortgage rates come down. So let's talk about what's going on in the industry right now. Mortgage rates have gone up higher than anybody predicted they would this year for two reasons. One is inflation got hotter than anybody was predicting. And the second, which put pressures on inflation, was the war in Ukraine. Okay, these are the two things that are driving the inflation bus up. So what happens? Inflation's going up, mortgage rates go up. What is the Fed doing right now? Every month when you turn on the news after a Fed meeting, what are they doing? They're raising rates, try to curb inflation, correct? You'd have to be living under a rock if you haven't heard that. So when the Fed gets inflation under control, and that is their primary goal, what is going to happen to mortgage rates?
Isn't today the Fed meeting?
No, today is the Jackson Hole. Fed Chairman Powell is speaking at the Jackson Hole Financial Summit today. That's what's going on today. And yeah, the market's going nuts today, waiting to hear what he's going to say. Markets are going crazy right now, just waiting to hear what Chairman Powell is going to say at the Jackson Hole meeting, because the markets can't determine whether or not rates are going to go up. He's going to raise rates 50 basis points or 75 basis points in September. Now, let me say this to you. Mortgage rates right now have basically planned for the worst. So if Chairman Powell announces in September he's raising rates 3/4, guess what's going to happen to mortgage rates? Either nothing or they're going to come down a bit because we finally got the word on what he's planning on doing, what the Fed's planning on doing. The markets don't like uncertainty, and there's all this uncertainty right now between 75 and 50 basis point rate hike, and that's why the Jackson Hole meeting today has created a lot of volatility in the market over the last 2 days, okay? But what I'm telling everybody who's freaking out about interest rates, and let me say this. First mortgage loan I ever closed, 14% adjustable rate mortgage. But that doesn't matter, because talking to a millennial first-time buyer about the fact that rates have been 14, 15, 16% means nothing to them. It's not the scope of their lifetime. All that they're thinking about are the artificially low interest rates of the pandemic when rates were in the high 2s and 3s. And I remind them, those were not real interest rates. Rates will not go back there. That's when the Fed was stepping in to make sure it kept the economy propped up. We know for certain that in the next 6 to 24 months, mortgage rates will be coming down. And so when I have a conversation with people right now, I basically say the rates that we have today, high 5s today, this week, because of all the uncertainty, are temporary interest rates. Rates will be coming down in 8 to 24 months. And everybody who bought a house this year is going to be in a great position to refinance. And we believe they're going to come down to somewhere between 4 and 4.5%. So when I'm talking with buyers today right now about where rates are and what their monthly payment is, I'm always giving them a payment at 4.5% as well. This is what your rate is now. Okay, so that's absolute certainty. It's very rare in my career I've been able to say, I know rates will come down. And now I'm telling you, rates will be coming down. Not sure when. It's going to depend on when the Fed gets inflation under control. And then here's the second question that I just wanted to give you some information on, about the housing crisis and how millennials are now going to wait for the market to crash again. It's not going to happen, guys. There is not going to be a mortgage crash unless there's some unforeseen catastrophic economic event in the United States. We are not going to see decreasing property values. We're going to see property values rate of appreciation slow down. We're not going to see double-digit home value appreciation going forward, but it's going to normalize we believe between 5 and 8% in Connecticut. Okay, and this is what I want to show you is kind of the cost of waiting. So this is the news, right? That we know that the media likes to stoke fears, and this happened to be a commentator who talked about the fact that we were going into another bubble in 2015, 16, 17, 18, 19, and 21. But the reason that we're not going into a bubble, I showed you guys very clearly what lending was like in 2000 to 2005. We have 2008. We have none of those lending standards going on. The single greatest reason why housing collapsed in those years was because of the subprime mortgage loans and because we had the Great Recession, where 1 out of 5 families was either unemployed or underemployed and couldn't afford to make their housing payments. Unemployment and loose lending guidelines. Do we have either of those two things today? No. We don't have either of those two things today. We're not going to see it. And I'm going to give you one last little piece of information that I happen to believe about Connecticut real estate, and that's this. From the years 2008 to 2018, every year, the government would publish a list of states who were starting to experience recovery out of the Great Recession and the economic collapse of housing. And every year from 2008 to 2018, guess who ranked dead last? Connecticut. We were dead last. Housing prices had already rebounded in most of the country prior to 2020. So you have housing prices going up, Florida, Nevada, California, all over the country, housing prices are going up 2014, 2015, 2016, 2017. Connecticut was still negative during those years. In addition, now those same markets got additional appreciation 2020, 2021, 22. We've just started to recapture home equity. We've just started to see home price appreciation. There was a published, I can't remember who published it, who said the top 10 markets that were least likely to experience a housing price issue. And Bridgeport, New Haven was one. They did metro population, and Bridgeport, New Haven was one of them. So in Connecticut, we're not going to see a bust. We're not going to see depreciating home price values. We're not going to see any of that. And on the right-hand column, this just shows you at the different rates of appreciation, the price of waiting. Home values will continue to get more expensive next year If somebody wants to wait till next year when they think rates are going to be lower, I can run an analysis for them to show them that it doesn't make sense to wait. Okay, and that's essentially the bottom line on that. Let's look at, if you look at this chart, if you have a price, the one like halfway down where it's 4.1%, home price 367. So if you go from if you look at a house that was 367 to the following year when it increased to 382, okay, that's what, $15,000 difference. And you think that you're gonna have to pay to refinance a loan and that cost is $5,000, you're up $10,000 in home price appreciation. So there's a lot to be said by really breaking down the numbers for buyers if they're feeling sidelined by interest rates and home prices. Does anybody have any questions at all that I can answer for you? Was this helpful?
Yes.
Very,
Good job.
Can't wait to come back in person next time. All right, my staff will compile all the different entries and I'll send an email list out to everybody, let know who the winner is. We'll get you a copy of the credit repair agencies, a copy of the property appraisal condition descriptions, and a copy of this PowerPoint. And if you need anything else, guys, you know where to find me. Happy Friday and have a great weekend.
Thank you so much.
Good job.
Thank you, Kelly.
Thank you, guys.
Bye.
You don't-
And that's-